Yesterday wasn't just a bad day for crypto. It was one of those moments when the entire market seemed to lose its footing all at once. A moment where the charts didn't just dip or retrace, but fell straight through the floor. Bitcoin didn't simply pull back, it collapsed. Altcoins didn't cool off, they were completely obliterated. And within a matter of hours, billions of dollars in open interest, leverage, and overconfident positions evaporated as if it had never existed. If you were watching that candle live, you probably felt it in your chest. The same deep sinking feeling traders get when they realise the market they thought was stable wasn't actually supported by anything solid at all. And yet the craziest part of all this isn't the size of the drop. It's that most people still don't understand what actually happened. They'll say it was panic selling. They'll say it was whales. They'll say it was macro or bad news, or that crypto is just volatile. But the truth is deeper and far more uncomfortable. Because yesterday didn't happen randomly. It wasn't caused by one headline, one piece of data, or one big sell order. It followed a structure, a blueprint, a pattern that repeats itself in every leveraged market in the world, especially one like crypto where the rules are loose, the order books are thin, and the biggest players have far more information than the average person watching the candles on their phone. Today, we're going to unpack that blueprint. We're going to walk through how the crash actually happened, the role market makers played, the difference between legitimate liquidity behaviour and real manipulation, and most importantly, how these moves are engineered, not by emotion, but by the architecture of the market itself. I'm Paula, welcome back to the channel, and if you're new here, this is where we cut through the noise, break down what's really going on in crypto, and talk honestly about the forces shaping this space behind the scenes. Right. Let's get into it. Let's start with what you saw on the charts. Bitcoin has been dancing around the 100k level for days. The market was tense, excitement was high, and everywhere you looked, people were talking about a breakout. Every influencer, every bullish trader, every comment section, everyone expected the next leg up. But beneath that optimism, the structure was starting to crack. The moment Bitcoin slipped below 100k, it didn't just drift lower, it fell as if someone had cut the rope holding it. A few $1,000s evaporated almost instantly. Ethereum followed right behind it, Solana, Cardano, XRP. Everything started free-falling in unison. XRP even dumped on the same day its ETF hit the Nasdaq, which tells you everything you need to know about how little fundamentals matter in moments like this. Within minutes, altcoins that had been slowly grinding upwards were suddenly crashing 7%, 10%, 15%. Liquidations began firing across every major exchange, and before the day was over, almost $1 billion in long positions had been wiped out. People woke up to blown accounts, leverage disappeared, stop losses triggered, margin calls hit, and traders who had been confidently long the day before were suddenly watching their portfolios bleed out faster than they could even refresh the app. But none of this explains why it happened, only what it looked like on the surface. And when you want to understand a crash, you don't look at the candle, you look under it. To understand yesterday's collapse, we need to talk about the people who actually shape these moves. Not retail traders, not whales acting alone, and not anyone buying or selling based on emotion. I'm talking about market makers. Not the shady villains people imagine online, but enormous, professional, deeply sophisticated firms whose job is to keep the market liquid. Firms like Cumberland, Jump Trading, Wintermute, and several others operating across every major exchange. These firms post buy and sell orders all day long. They tighten spreads, they provide depth, they hedge risk across multiple venues, and without them, the market would feel like a ghost town. But here's the part that most traders don't understand. Market makers don't care about the price of an asset. They care about the flow of orders. They want to know where people are placing stop losses, where liquidations will trigger, where retail is overly confident or overly exposed, where leverage positions are clustering, where the biggest pockets of liquidity sit on the chart. Because wherever liquidity sits, that's where price gets attracted. Not because market makers want to manipulate anything, but because the system rewards moving price into the areas where the most orders are waiting to be filled. And yesterday, the biggest pool of liquidity sat below 100k. Let's break down why the market was so vulnerable leading up to the crash. First, the market was heavily over-leveraged. Funding rates were positive across the board, meaning long traders were paying shorts just to keep their positions open. This happens when too many people are leaning in the same direction. In this case, all leaning long. Second, retail sentiment had become too predictable. People expected a breakout. People were FOMOing into altcoins. People were setting stops beneath obvious levels. It created a situation where the entire market was essentially standing on one leg. And third, the liquidity beneath Bitcoin. The orders sitting just under 100k became a magnet. This wasn't hidden. Anyone looking at order flow could see it stacking up. All of these stops and liquidation levels created a huge pocket of opportunity. Now add macro pressure. Stock market weaknesses, uncertainty around US fiscal policy, and rate expectations shifting again. And suddenly the market didn't have the fundamental support people assumed it had. It wasn't that bad news caused the crash. Bad news simply made the structure easier to break. So here's where the entire narrative shifts, because the crash didn't begin with a huge wave of selling. It began with something much simpler. The buy-side liquidity disappeared. Market makers reduced their bids. Order books thinned out. Support levels hollowed. When those bids vanished, the market didn't need a massive sell order to break. It only needed a slight knock. And when that knock came, price slipped directly into the pocket of liquidity below. That triggered the first set of stops. These stops triggered the first wave of liquidations, and those liquidations triggered more and more and more. And once the liquidation cascade starts, it feeds itself. Nothing stops it until it hits a level where bid return and real buyers step back in. This isn't manipulation. This is a structure of leveraged markets. But market makers do know how that structure works. And if you're expecting them to hold the market up while retail stands on a pile of unstable leverage, you're misunderstanding their job entirely. Here's the part that most traders underestimate. The market didn't fall because a lot of people sold. It fell because a lot of people were forced to sell. When you open a leverage position, you don't always get to decide when it closes. The exchange does. And when price hits your liquidation level, your position closes at whatever price is available, often far worse than traders expect. Every liquidation becomes a market sell, which pushes prices deeper into the next liquidity pocket, which triggers more liquidations, and the cycle continues. This creates the steep, sudden vertical drop people mistake for panic selling. But the truth is far simpler. It was liquidation selling. And guess who profits during liquidation? Exchanges collecting fees, market makers hedging against predictable moves, firms buying cheap liquidity, bots filling orders at discounts, and large players resetting their positions into a cleaner, less crowded market. Retail is the one paying the price, literally. Now let's talk about the behaviour people often label as manipulation. Market makers are allowed to do things that feel aggressive. They can pull liquidity before major news. They can fade FOMO-driven rallies. They can position against retail-heavy sentiment. They can target predictable stop clusters. They can allow price to run into liquidation pockets. They can hedge in ways that reinforce downward movement. None of this is illegal. None of it is shady. This is the professional side of trading. And this is where traders need to understand the difference between manipulation and strategy. Manipulation in the legal sense is specific. Spoofing, wash trading, fake liquidity, coordinated pumps or dumps, deliberately misleading markets. These things happen. We've seen the SEC and CFTC prove it with real cases, but they weren't necessarily to cause yesterday's crash. The move was perfectly achievable using only the structure of the market. Too much leverage, too many longs, too much liquidity sitting beneath a key level, and a moment of weakness where liquidity providers simply stepped back. That's all it took. Was yesterday an example of illegal manipulation? There's no evidence to suggest it was. Was it guided by market structure in a way that benefited large players? Absolutely. Did market makers accelerate the move by removing liquidity? Almost certainly. But again, that is part of their role, not a violation of any rules. Was retail on the wrong side of the trade? Without question. And was the crash predictable? Yes. Painfully so. If you were watching liquidity maps, order books, funding and leverage, the entire move was predictably trapped. The entire move was practically telegraphed. This isn't a market out to hurt retail. This is a market reacting exactly how it's designed to react. Retail simply misunderstands the design. Crypto markets are not fair. They're not decentralized in the way people imagine. They're not driven by simple supply and demand. They're not over-governed by the crowd. They are driven by liquidity, order flows, leverage, market maker positioning, exchange incentives, and a predictable pattern of retail behaviour. Retail trades emotionally. Retail enters late and exits early. Retail clusters stop in obvious places. Retail uses too much leverage. Retail buys at resistance and sells at support. And market makers simply operate around that behaviour. They don't target individuals, they target mechanics. And if those mechanics cause retail to lose, well, that's just the structure of the game. The purpose of this video isn't to convince you that the market is evil or that you're battling a shadowy cartel. It's to show you that these crashes are not random events. They're the natural outcome of how crypto markets are built. And once you understand the structure, everything begins to make sense. You stop seeing red candles as disasters. You start recognizing where liquidity sits. You start spotting the traps. You stop being emotionally manipulated by volatility. You understand why these moves happen and how to position ahead of them. When you understand the system, you stop being the liquidity and you start trading like the person who recognizes how these cascades form. Knowledge is an edge. Most people don't have it. Now you do. If you want to go deeper into these moves, if you want to follow the liquidity, understand the structure and actually see these shifts as they're forming instead of after the fact, this is exactly what we break down inside the Crypto Wolfpack. We analyze the macro drivers, the liquidation maps, the market maker behavior, and the exact dynamics behind these moves in real time. So you're not reacting blindly, but trading with clarity. If you want to join these conversations, the link is in the description below. If this helps you to understand what really happened during the crash, hit like, drop me a comment telling me where you were when you saw the drop happen, and subscribe for more deep dive breakdowns just like this. Thank you for watching, and as always, stay smart, stay safe, and I'll see you on the next one.